Hello and welcome to this episode of my tutorial video series. The subject of this video is financial management, specifically portfolio management, and the topic is Professor Walter's dividend model. Professor James E. Walter developed this model for valuation of stock of a company. Walter postulates that the price of share of a company is influenced by the company's dividend policy. The model is based upon the relationship between the internal rate of return, that is IRR of the company, and the company's cost of equity. And the other factors that make up the model are the dividend per share and earnings per share. Now, the basic postulation is dividend policy influences the price of shares, and it is based upon these factors: IRR, that is internal rate of return, K is cost of capital, D is dividend, and E is earnings per share. Now, the model is based on certain assumptions. What are the assumptions? Number one, perfect market. That means all the investors have perfect information about all the securities in the market. Correct? Number two, only equity finance. The company is operating in the capital market where only equity finance is available. There is no debt financing, no preference capital. Why there is no debt financing or preference capital? Because preference capital is basically hybrid kind of capital, and debt capital is fully debt capital. In order to neutralize the effect of financial leverage in the capital structure of the company, James E. Walter has excluded any kind of debt. That means the only finance available to the company is equity finance. Next, third assumption is retained earnings is the only source of finance for reinvestment. Whenever the company is thinking of investing in new projects, the company will invest from its retained earning. No further equity shares will be issued for this kind of investment. Next is constant R, that is internal rate of return, K, that is cost of capital, EPS, earnings per share, and DPS, dividend per share, and no transaction cost, floating charge, and corporate tax. It is also assumed that there is no transaction cost. Transaction cost of what? Of purchasing or selling shares. No floating charges, that is there is no charge in issuing new shares, and there is no corporate tax. And the last assumption is infinite life of the company. That is, the company is assumed to work in perpetuity. Okay. Now, Walter has distinguished between three kinds of firms. Number one, growth firm. Number two, shrinking or declining firm. This more appropriate word is declining. Instead of shrinking, the more appropriate word is declining firm. And the third is normal firm. These three types of firms are characterized by the relationship between R and K, that is IRR, internal rate of return, and the cost of equity. In case of growth firm, the company is characterized by R being greater than K, that is the internal rate of return is greater than the cost of equity. Next one is declining firm. In case of declining firm, the IRR is less than cost of equity. And in case of normal firm, R is equal to K. That means internal rate of return is equal to cost of equity. Now, first we consider the growth firm. If R is greater than K, that means the company is earning more than the cost of capital. So there is point for reinvesting the profit into the business instead of paying dividends. Now K is the cost of equity. That means if the company pays dividends to the shareholders, then if the shareholders invest in some other opportunities, then they will earn this much return. Now if the company can provide the shareholders a return more than this cost of equity, that is R is more than K, then the firm will want to reinvest the profit instead of paying dividends. So in this case, the dividend payout ratio will be 0%. That means instead of paying any dividend, the company will fully reinvest the profit. Okay, and this is the optimum debt payout ratio, that is 0% for a growth firm. Now come to declining firm. In case of declining firm, R is less than K. This means the internal rate of return of the company is less than the cost of equity. This means the company is not able to provide the return to the shareholders which the shareholders themselves can get. So there is no point in reinvesting the profit again. Instead of that, the firm will pay the whole profit as dividends to the shareholders, and shareholders will invest the fund to other opportunities, so that full dividend will be paid. That is, the dividend payout ratio will be 100%. Whole profit is being paid as dividend to the shareholders. Now third one is normal firm, where the internal rate of return is equal to the cost of equity. Now if the internal rate of return is equal to the cost of equity, then the firm is indifferent between all the DP ratios, that is dividend payout ratios. This is immaterial whether the firm is reinvesting the profit or the firm is paying the profits as dividend to the shareholders. In this case and in this case, that is for a growth firm and for a declining firm, the dividend payout ratio is going to influence the price. Price of what? Price of stock. But in case of a normal firm, the DP ratio or the dividend policy will not influence or will not make any change in the price of the shares of the company. Okay. Now the model is structured with this formula: P equals to D plus R by K multiplied by E minus D whole divided by K, where P is equal to price of the share, D is equal to dividend per share or DPS, E equals to earnings per share or EPS, R equals to internal rate of return or IRR of the company, K is cost of equity capital. Remember, there is no debt financing. So there is only cost, that is cost of equity. Okay, now we will take numerical example to see how a growth firm, a declining firm and a normal firm make up their optimum DP ratios. So I have to erase this part so that I can proceed to the numerical example. Okay, let me erase this part. Yeah. So we can take our numerical example. P equals to D plus R by K into E minus D divided by K. This is the structure. This is the basic formula of Walter's dividend model. Now we are considering three forms: growth, declining, and normal. Cost of equity K equals to 10%. IRR R equals to 15%, 8%, 10%. D equals to rupees 10. Okay. Now for a growth firm, R is greater than K. For declining firm, R is less than K, and for a normal firm, R is equal to K. Now here R is 15%, because in between these three IRR only 15% is more than 10%. So for growth firm, R is 15%. In case of declining firm, R is less than K. In between these three IRR, 8% is less than 10, so 8% is applicable here. So R equals to 8%. And R equals to K when R is 10%, because K is 10%. So R equals to 10%. Okay. Now we consider DP ratio 0%. 0% for all the three firms. Correct? Now we find out the value of P. P equals to D plus R by K. So here DP ratio is 0%. That means dividend is 0%, that is 0, plus what is R? 15% divided by K. What is K? 10% into E minus D. Sorry, this is E, not this is E. So 10, EPS is 10 minus dividend is 0 by 10%. Here R is 8% and DP ratio is 0%. So dividend is 0 plus 8% by 10% multiplied by 10 minus 0 by 10%. Correct? Here R equals to K and DP ratio is 0, so D is 0. 0 plus R is 10, K is 10, multiplied by 10 minus 0 because D is 0. The whole divided by 10%. So this becomes how much? 15% by 10%, that is 1.5. 10 minus 0 is 10 into 10 by 10%. This is equal to 15 by 10%. Now 15 by 10% means 150. Here 8% by 10% equals to 0.8. Into 10 minus divided by 10% equals to 0.8 into 10 means 8 by 10% equals to 80. And here 0 plus 10% by 10% means 1 into 10 by 10%, that is 10 by 10%. Now 10 by 10, if you want you can use calculator also. 10 by 10% means 100, correct? Now consider DP ratio. %. DP ratio is 100%. Now you can take DP ratios 20%, 50%, 30%, 40%, 50%, and in this way you can go on increasing the DP ratio. But I am doing two extremes, it is 0% and 100%, so that we can come to a conclusion. 100%, and here also DP ratio 100%. Now what is the price? P equals to, now DP ratio 100% means the whole of the earnings per share is paying as dividend. So D and E become equal. So here it will be earning per share will be 10, so D will be 10. 10 plus 15% divided by 10% multiplied by 10 minus 0 whole divided by 10%. Okay. Here DP is 10%. 100%, DP ratio is 100%. So D is 10, so 10 plus R is 8% divided by 10%, K is 10%. Into 10 minus 10 divided by 10%, isn't it? E and D are equal because the company is paying 100% dividend. The whole of the earning per share is being paid as dividend. So E minus D will be 10 minus 10 in all the cases. Right? And here it will be 10 plus 10% by 10% into 10 minus 10 divided by 10%. Okay. So this becomes how much? 10 plus 1.5, 10 minus 10 is 0 into 0 by 10%. Here 10 plus 8% by 10% means 0.8. 10 minus 10 is 0 into 0 by 10%. And here 10 plus 10% by 10% means 1 into 10 minus 10 is 0 divided by 10%. Correct? So this becomes 1.5 into 0 means 0, 10 by 10% equals to 100. Okay, here it is 0.8 into 0 is 0, it is 10 by 10% equals to 100. Correct? And here 10 by 10% equals to 100. Correct? Now notice very carefully. DP ratio increases from 0% to 100%. At the same time, price of share decreases from 150 to 100. That means in between these two extremes, that is 0% DP ratio and 100% DP ratio, 0% DP ratio is optimum dividend policy for growth firm. Why? Because as the firm is increasing DP ratio, the price of share is falling. At 0% DP ratio, price was 150. At 100% DP ratio, price has fallen to 100. Correct? Here you see the reverse has happened. Here you see DP ratio has increased from 0% to 100%. And price per share has increased from 80 to 100. That means 100% DP ratio is optimum for this declining company. If the company pays 0% DP, that means 100% retention, then the price of share is 80. If the company makes 100% dividend DP ratio, that means the company pays whole of the earning per share as dividend per share to the shareholders, then price of share is increasing. So this is the optimum dividend policy of declining company. And here you see, as DP ratio increases from 0% to 100%, you see price of the share remains the same. There is no change in price of shares. That means a normal company has no dividend policy. That means this company is indifferent between all the dividend payout ratio, that is from 0% to 100%. Okay, so we can say this is growth firm, this is declining, and this is normal. DP ratio going up, price of share falling. For a declining company, DP ratio going up, price of share is increasing. DP ratio increasing 0 to 100% for a normal company, and the price remains neutral. Price is not changing. Another way of saying that, when DP ratio falls, if we move from bottom to the upper level, the top level, what you see, if DP ratio falls from 100 to 0, then P is increasing, price of share is increasing. When DP ratio of a declining company is falling from 100% to 0%, price of share is falling. So that price will fall. And in case of normal company, again neutral. So for a growth firm, 0% DP ratio is optimum dividend policy. For a declining firm, 100% DP ratio is the optimum dividend policy. And for a normal firm, there is no optimum dividend policy. The firm is indifferent between all the dividend payout ratios, varying from 0 to 100. Okay. So what you have learned, that the growth firm is characterized by R being greater than K, that is IRR is greater than cost of equity. A declining firm is characterized by R being less than K, that is IRR is less than cost of equity. And a normal company is characterized by R being equal to K, that is IRR is equal to cost of equity. Correct? And this is the structure of Walter's dividend model, where P equals to D plus R by K multiplied by E minus D by K. Now you see, this P has two parts. What a rational investor expects from purchasing stocks. One part is earnings in terms of dividend, and another part is gains in terms of reinvestment by the company. Now this part D by K shows the gain in terms of dividend, and this part R by K multiplied by E minus D divided by K, this part represents the gain in terms of earnings from reinvestment by the company, that is from the retained earnings being reinvested, and these two make up price of the share. Now we have considered cost of equity K as 10%, IRR, that is R, we have considered three different IRR: 15%, that is for the growth company, 8% for declining company, and 10% for normal company. E equals to ₹10 and cost of capital being 10%. So for growth company, R is greater than K, for a declining company, R is less than K, and for a normal company, R is equal to K. Okay. Now we have taken two DP ratios, one is 0% and another is 100%. And we have calculated the price with this data along with DP ratio 0% and DP ratio 100%. All of these remaining same. That means K, R, E remain same. So here you see DP ratio 0%, that is D is 0, IRR 15, K is 10%. We have put the values in the formula, and we have found out that 150 is the price of share for the growth firm. For the declining firm, R is less than K, R is 8% and 8% is the only IRR which is less than K. So R equals to 8 is applicable in case of declining company. Again, DP ratio 0%. We have put the values in the formula and we have calculated the price as rupees 80. Price of share is rupees 80. And for a normal company, R is equal to K. Since K is 10% and only equal R is 10%, so R is 10% as well as K is 10%. DP ratio is 0%. Again, we have put the values in the formula and we have found out the price as being 100. So with 0% DP ratio and applying these 3 IRR, we have found out the price per share is 150 for growth company, 80 for declining company and 100 for normal company. Next, we have taken 100% DP ratio, that is another extreme. Once we have taken 0% DP ratio, here we are taking 100% DP ratio, the another extreme. Here we have put the same data, only change is that D has changed. Here D is 100%, since E is rupees 10, so D is 10. So 10 plus 15% by 10% into 10 by 10 by 10% for growth company. For declining company, 10, that is D plus R by K, 8% by 10% into 10 minus 10, E minus D. E and D are same by 10%. And for a normal company, D is 10, R and K are 10%, both are 10%, and E minus D equals to 10 minus 10 divided by 10%. K is 10%. Okay. So here we find that price of share is 100 for the growth company, 100 for the declining company, and 100 for the normal company. Now we compare these prices between DP ratio 0% and DP ratio 100%. We see as DP ratio is increasing from 0% to 100%, the price per share of the growth company is falling from 150 to 100. In case of declining company, when the DP ratio is increasing from 0% to 100%, price per share is increasing from 80 to 100. Just the reverse is happening compared to growth company. And it is interesting, in case of normal company, when the DP ratio is increasing from 0% to 100%, the price per share remain unchanged, 100. At DP ratio 0%, the price was 100, and at DP ratio 100%, the price is 100. So we can conclude, as DP ratio increases, in case of growth company, price of share will fall. If DP ratio increases, in case of a declining company, price of share will rise. If DP ratio increases, in case of a normal company, price of the share remains unchanged. Another way of saying the same thing is that if DP ratio is going down, say from 100% to 0%, price per share for a growth company is increasing from 100 to 150. If DP ratio is falling from 100 to 0%, then the price per share is falling from 100 to 80. Or in case of growth company, when DP ratio is falling from 100% to 0%, price per share is increasing from 100 to 150. And in case of declining company, when the DP ratio is falling from 100% to 0%, price per share is falling from 100 to 80, and in case of a normal company, when the DP ratio is falling from 100% to 0%, the price of the share remains unchanged. So this is the optimum dividend policy of a growth company, that is 0% DP ratio. This is the optimum dividend policy of a declining company, that is 100% DP ratio. And a normal company does not have any optimum dividend policy, because the dividend policy is not influencing or impacting the price of the share. So when DP ratio rises, in case of growth company, price falls. In case of declining company, price increases. And in case of a normal company, price of share remains neutral. When DP ratio falls, earlier when DP ratio increases. When DP ratio increases, in case of growth company, price falls. In case of declining company, price rises. And in case of normal company, price remains neutral. Price does not change. And when DP ratio is falling, price of a share of a growth company is increasing. Price per share of a declining company is falling. And price per share of a normal company remains same. Okay, so this is Walter's dividend model. This is a very practical approach to the valuation of price of stock of a company. Although Walter's dividend model has been criticized on many grounds, almost all the assumptions are criticized. It is said that there is no perfect market in real world. Number two, it cannot happen that only equity financing is available, there is no debt financing. If there is no debt financing, then there is no financial leverage. Okay, and financial leverage is a very strong weapon for a company to amplify return to the shareholders with the use of debt capital. Of course, debt capital increases financial risk too. But in actual practice, the company procures fund from equity capital, equity financing as well as debt financing in order to derive financial leverage. Next, it is said that constancy of IRR, cost of capital, earning per share and dividend per share is also unrealistic. When we are talking about 0% DP ratio, that is not, the company is not paying any dividend, that is very unrealistic assumptions. Because when a company does not pay any dividend, a rival company which is paying dividend become more attractive to the shareholders, prospective shareholders. Receiving cash dividend is an important psychological booster for an investor. So it is very unrealistic that the firm will not pay any dividend. 100% retention of profit is very unrealistic assumption. So these are the criticism. Again, Walter's dividend model. In spite of that, the model stands a strong structure to value the price of a share, and the postulation that dividend policy of the company influences the price is very pragmatic one. Correct? Yeah. So this is all about Walter's dividend model. Yeah. We have learned the postulations, we have learned the assumptions, we have learned the formula, we have learned how the optimum dividend policy is determined by the companies, for a growth company, for a declining company, and for a normal company. A growth company is characterized by R greater than K. A declining company is characterized by R less than K, and a normal company is characterized by R being equal to K. Okay, and we considered three IRRs, 15%, 8%, and 10% to suit these three companies: growth company, declining company, and normal company. For the growth company, IRR is considered 15% to make it more than K. For declining company, IRR is considered 8% to make it less than K. And for a normal company, IRR is taken as 10% to make it equal to K. And we have considered two DP ratios, 0% and 100%, and we have learned how the company finds out the optimum dividend policy or the optimum dividend payout ratio. Correct? Yeah. Right. So I hope you have enjoyed this video. Please do subscribe our channel. Please do like our channel. Okay. And thank you for watching this video. Goodbye and stay well.